Assalamu alaikum friends, so welcome to question 7. So question 7, it is about a Zippy, and he is into manufacturing company with a reporting date of 30th June 2006. It has investment properties as well as other entities, and you have been given the draft statement of profit and loss of the comprehensive income, right, of Zippy. So as you can see, now relating to Guinea, so definitely Guinea is a subsidiary, and also office blocks. This might be the investment property. And now let us go to the requirements first. Okay, so explain with suitable calculations how the investment in Guinea should be accounted for in the consolidated statement of profit and loss and other comprehensive income for the Zippy's group. Okay, so suitable calculations. So this type of questions where they say suitable calculation means that you have to decide what are the calculations, right? For example, we need what are the items that will go in the consolidated statement of profit and loss and other comprehensive income. Consolidated. So for that consolidation pass, what do you need? All those things you have to calculate. For example, what are the things here? They asked consolidated statement of profit and loss and other comprehensive income. Okay. So here they didn't say consolidated financial statements. Okay. So only calculate those items which is needed for the consolidated statement of profit and loss and other comprehensive income. Okay. So let me highlight it. Just give me a minute. Okay, so suitable calculations. So in the profit and loss, the investment for Guinea, it's a subsidiary. Okay, how it will go? 11 marks. Then next is suitable calculations how the two office blocks should be accounted for in the consolidated financial statements of the Zippy group. For this is about the consolidated financial statements. Okay, this is about the two office blocks relating to two office blocks. 8 marks. Third, explain why the accounting treatment of 10 floor office. Okay, so this is relating to 10 floor office block in Zippy is individual. Okay, it is individual. Non-consolidated financial statements will differ from the treatment in the consolidated group. Calculations are not required. Still candidates go and give calculations in spite of telling that calculations are not required. The reason why they have included the sentence, even if they want, they like they might not have included the sentence, right? But if the sentence was not there that calculations are not required, then you have to give calculations. Even though the word says explain how the treatment might be different in the consolidated and individual, still you need to show some treatment, right? How it to show the difference. So now since they have clearly written calculations are not required, so that makes your work much easy. Calculations are not required, don't do calculations, but you have to explain the accounting treatment. Okay, so why it is different in the individual financial statements compared to the consolidated. Okay, you should always be prepared for such questions in group accounting, individual versus consolidated accounts. Okay, and individual and consolidated accounts are dealt under two separate standards. Okay, I hope you know the two standards. I don't have to repeat the standard name. And then coming to requirement B. Yes, so requirement B is relating to other comprehensive income, as we can see. So we'll read it, and 7 marks. So for requirement B we have a small so this part, okay, this whole paragraph is relating to requirement B only. So that means whatever above we are going to read is only for requirement A. Two things are there. One is the subsidiary of Guinea, the other one is office block. Okay, that is the investment property. So shall we, so now you have an option. Either you can answer requirement B or A because it is not linked. Okay, so let me start with A because majority of my marks I know it is from part A, right? And since I have been doing group accounting a lot of times, so A would be easier for me even though it has more calculations and more things to do, but A will be the easier one. Okay, now let me go to the case study in detail. So now we have to read the Guinea, right? See all these financial statements and all, if it's given to you, it saves a lot of time for you because you don't have to read this, no? You can just go through it. No need to read. We know how a profit statement and other comprehensive income looks like. We know how a financial statement looks like, statement of financial position. So we don't have to read all those items one by one. Okay. So that's a good thing. It saves time, and now you can directly read just under two subheadings. One is Guinea, one is office blocks. Okay, so office blocks we'll read later. First we'll start Guinea and we'll start answering the requirements relating to Guinea. Okay, so I think let us go to the requirement. Office block. So first part of A is only for Guinea. The rest two is for two office blocks. Okay, so we are only going to read Guinea. Okay, sorry, Guinea. So on 1st of July 2004, acquire 60%. Okay, that means it's a subsidiary of Guinea, a Poland limited company. Purchase consideration compromise cash and fair value of identifiable net assets. Okay, so the purchase consideration is cash of 90 million. Fair value of net assets acquired 114 at that date. Zippy uses full goodwill method. Okay, so fair value of NCI, because full goodwill method, fair value of NCI will be given to you, or sometimes you have to calculate. Here it is given to you. So fair value of NCI is 50 million on 1st of July 2004. So to calculate goodwill, see, all the information is given. You need three things to calculate goodwill: purchase consideration, which is 90 million, fair value of identifiable net assets, which is 114 million, and fair value of NCI, which is 50 million. Okay, so now you can calculate goodwill. So goodwill has been reviewed annually for impairment, and no impairment was deemed necessary. That means no impairment, just the goodwill. Okay, no impairment. Next, second paragraph, dispose 20%. So from 60 to 20, if you dispose, well, you are left with 40. That means you are becoming from subsidiary to an associate, because less than 50%. Okay, so dispose 20%. When? 31st March 2006, not in the same year. This is on 1st of July 2004. This is 31st March 2006. Not even 2 years, less than 2 years. For cash, for how much? For cash, 44 million. On the disposal date, remaining 40% holding. Okay, so the remaining means from 60 to, after you dispose 20, what is the remaining? That is 20%. That is your associate. Okay, so the remaining associate, you need to know the fair value. It has a fair value of 62 million, and Zippy was left with significant influence over Guinea. The reason why they are saying significant influence is so that you can say it's an associate, right? Next, Zippy accounts for investments and subsidiaries at cost. And okay, so this is they are giving the things relating to individual financial statements. Okay, so Zippy accounts for investments and subsidiaries at cost and has included a gain in investment income of 14 million within its individual financial statements to reflect the disposal. Gain in investment income. Okay, so gain. Wait, just okay. So now, what is they saying? Here accounts for investment in the individual accounts they're talking about. Since Zippy is acquiring the subsidiary, so investment in subsidiaries at cost and has included a gain in investment income of 14 million. So gain in investment income of 14 million within his individual financial statements to reflect the disposal. Okay. Nowhere the individual financial statements are given. If you see up, okay, it is where it's not given. Okay, you have been given the comprehensive profit and loss and other comprehensive income. You have not been given the individual financial statements. It is explained in this paragraph. Okay, so through this paragraph, you know individually what they have written. Okay, Zippy. Okay, this is not the consolidated. Only Zippy recorded that investment in subsidiaries is at cost, and also there's a gain in investment income in Zippy's account, individual account of 14 million. Okay, because there was a disposal, so relating to that disposal, there's an investment income of 14. Now the net assets of Guinea had so net assets of Guinea had a fair value of 118 million at 1st of July 2005. 1st of July 2005. Look at the date. It's not the date when they have disposed. Okay, that is the closing. Pen is not working. I don't know what's wrong with the pen. So 1st of July 2005. Okay, and this was reflected in the carrying amount of the net assets. All gains and loss of Guinea had occurred even through the out. So all gain and losses evenly throughout the year. Okay, the disposal is not classified as a separate major line of business or geographical operation. The reason why they have given is this: this disposal is not classified as a separate major line of business or geographical operation. Why this statement is given? To know what? To know that IFRS 5, you are not using IFRS 5. What is IFRS 5? Non-current assets held for sale or discontinued operations. Okay, so when you're discontinuing an operation or when you're selling a non-current asset for a sell, then you cannot deal using non-current asset IAS 16. Neither you can deal the disposal of a subsidiary or something. Okay, it is dealt under IFRS 5. Separate standard is there. But the reason why they have told us that this disposal is not classified as a separate major line of business means you are not using IFRS 5. It is a disposal of what? You don't have to use IFRS 5. It is not a disposal of a separate major line of business or geographical operation. If it was a disposal of separate major line of business or geographical operation, you have to use IFRS 5. That's the reason why they have given it here. Okay. So now office block we are reading later. With this we can answer. Now let us go to the answer. So the answer starts first 9 months. Very important. The date is very important when accusation. Okay, so we'll go through the dates first. Understand the dates. First 9 months they are telling, right? So here, 1st July 2004 they have acquired, and the reporting date is what? It is 30th June 2006. That means June is the closing end. Okay. So disposed of, just so okay, the date, the question asked you the date. Okay, go to the requirement back again. They asked for this year, 30th June 2006. For this year end they want 30th June 2006. Okay, so you disposed 31st March. Okay, that means before the date of disposal you have to calculate from the date of the accusation. Only in that period, even though you have acquired on 1st of July 2004, you cannot take that because you have to calculate for 12 months for 30th June 2006. Okay, so what will come? And from 31st March 2006 to 30th June 2006 you cannot take into account, it is disposed. That means before that. Okay, so 3 months. So April, May, June, this 3 months you cannot take, they are disposal period. These three periods, they are being associate. That means before this 3 months they were subsidiary. So that's why first 9 months. Okay, first 9 months they are subsidiary. So that's why it says first 9 months. I hope you can understand now, right? So don't jump straight to the disposal calculation. After all, Zippy did not dispose of all the shares until 9 months into the reporting period. Please understand. Reporting period means it is asking 30th June 2006. So that means from 1st of July 2005 till 30th June 2006. This is the whole 12 months. Right? So in between this one, from 1st of July, deal each aspect separately. Okay, don't jump into the disposal first. From 1st of July, it was disposed when 31st March. So that means until 31st March 2006. Okay, only this period you are taking, even though you have acquired it in 1st of July or when or 10 years before, it does not matter. Only the reporting period, the last 12 months, that is until 30th June 2006. The requirement says the date already. The requirement will always give you the date, 30th June 2006. That's why from 1st of July 2005 to 30th June 2006 is the reporting period. So in this reporting period, how much for how many months you were a subsidiary and how many months you were an associate? That's what the question is asking you. So from 1st of July to 31st March 2006 you have been an subsidiary, and you have disposed on 31st March. That means from 1st of April 2006 until 30th June. Okay, 2006. It should cover this whole period. Okay, in this whole period you are not the same, your status changed. First 9 months you were a subsidiary, then remaining 3 months you are an associate. So now you are an associate. If you're not understanding in one go, then you better separate it out like this and write it in parts. So April, May, June, 3 months. 3 months, okay, so 9 months, first 9 months, okay, subsidiary, and 3 months associate. Okay, last 3 months he has been an associate. So that's why it is first 3 months. Okay, next. Now, so starting with it. So the first 9 months of the year, Zippy had control over Guinea. What did Zippy had? First, mention the date. First 9 months. It's important when something happens during the year, you need to say first 9 months. Who had control? ZP had control over Guinea. Very important that you should mention the word control. Control is the key word here. That ZP still has control over Guinea. This says that you have to consolidate or he's a subsidiary. That's why control word is very important. Okay. ZP had control over Guinea and so Guinea was a subsidiary during this time. During which time? During this first 9 months, you have to say it very clear. Or there is another way of writing this sentence. So many ways are there, but one way, for example, for those students who are saying how to write this in your own words, okay? So you can write that Guinea is a subsidiary for the first 9 months because Zippy has a control over Guinea. You can even write the percentage, 60%. Therefore, they need to consolidate. So you can write like this also. So many ways are there, okay? Zippy must consolidate Guinea's income and expenses and other comprehensive income on a line by line basis. Okay, so must consolidate what? Income and expenses. You have to talk specifically about income and expenses. Don't just say they have to make consolidate. Okay, consolidation account. What? Consolidate what? Income, expenses. Why income and expenses? Because the question asked you, requirement asked you. Statement of profit and loss and other comprehensive income. So in the profit and loss, what are the items that goes? Income, expenses, and then OCI, other comprehensive income. Don't forget OCI. Don't forget OCI. They asked OCI also. Now, how to consolidate on a line by line basis? On a line by line basis for the first 9 months of the year, right? You have to apportion the time. You cannot consolidate full amount of guineas. Only first 9 months of guineas, income, expense, and OCI item line by line you are taking and consolidating with Zippy. This is what you are doing. Okay, I hope you understood the scenario now. That also on what basis? Line by line basis. Each item you're dealing separately, line by line. Okay, for example, sales, then cost, then this cost, that cost, everything. Okay, next paragraph. So now write each item in different paragraphs. Okay, first you are writing generally what you are doing. He's a subsidiary, he has a control, therefore consolidating the first 9 months line by line basis. That's all. That is your first paragraph. Okay, first paragraph. Second paragraph onwards you can start line by line item. What is the word? Profit. So you can talk about profit, how you are going to consolidate profit. Some working is required here, that also you can do. So Guinea made a profit of how much? 32 million for 12-month period. Please mention the time period when you are doing time apportioning, that this profit is for this much, so I am time apportioning it, the profit is now this much. So first for the 12-month, 32 million. So how much it will be for the 9 months? Working is here. Just take 9 months of 32 million, okay, which is 24 million now. So this must be consolidated, not 32, not the 12-month period's profit 32 million. No, 9 months of that 32 million should be consolidated, which is 24 million. Understood? Of this, don't just stop there. Out of this profit, how much is for the parent and how much is for the NCI? So of this 9.6 is attributable to the NCI. Because why are you writing this? How much it is for NCI? Because in the OCI section or in the profit section also, okay, when you see your profit, okay, let me show you the in the question how it is. So this is the profit for the year, this 32, you are taking 9 months, so 24 million for this one. Now if you go down, okay, that thing is not there, but after profit in the consolidation account there are two parts. One is for profit, one is for OCI. For profit, we always take how much we are taking for the parent and how much we are taking for the NCI. We are showing it separately. Same for OCI, how much is for the parent, how much is for the NCI. That is the reason. Because when we are making the consolidated profit and loss account, we need that NCI portion of profit. That's why we are calculating and writing it here. That Out of this 24 million, 40% is attributable to the NCI because 60% you've acquired, so 40% NCI, which is 9.6 million. You need this 9.6 million later on, okay? Because the question asked suitable calculations. So you need the NCI, percentage of profit of the NCI. Same for the OCI also you need. Second paragraph is, third paragraph is OCI. Please see how I'm dividing the, not me, how the paragraphs are divided. This helps you a lot in starting or structuring your answer in this way and a paragraph form ways. Okay, each item in each paragraph. Okay, line by line, because we told line by line. So profit, second paragraph. OCI, third paragraph. You are not combining profit and OCI in one paragraph or mixing together. Both things are separate and it should be kept separate. So recording OCI of 16 million for 12 months, same how you have wrote for profit, you are writing for OCI. Okay, this helps a lot. First of all, consistency is maintained. Second, you don't have to remember too much. It's just like you are filling the blanks. Okay, copy pasting exactly the same thing. Instead of profit, you are writing OCI. Instead of writing the figure for profit, you are writing the figure for OCI. That's it. Rest everything is same. Percentage is same. You're taking the 9 months of that OCI. Rest all remains the same. So not 16, it's 12 million because 9 months of 16 million must be consolidated. Okay, how you have wrote for, just see the second and the third paragraph and see word by word. It is everything is same except profit is replaced with OCI and the figures are changed. Okay, so now even here also 40% will go to NCI. Okay, keep this ready here. Later in the calculations you need it, but you need to write it. Okay, 11 marks is just not given for calculations alone. Come on. You will be doomed if you think that calculations only is 11 marks. No, it is not so. Why? Because let us see the requirement again. Explain. The word explain, you see. With suitable calculations, you need the support of calculations, but you have to explain. Even the second one also explain. Even the third one also explain. Everything is explained. Okay. So now let us keep it ready. Okay, now loss of control. Now we are coming to the disposal part. We are over. Okay, OCI 60 OI. OCI 16 million. This one. Okay, this 16. Don't take 48. 48 is the addition of sum of the profit and the OCI. 16 plus 32, 48. No, we are taking just the OCI, other comprehensive income. And on the other comprehensive income, there's only one item, that is the gain on property revaluation, which is 16. That's 16 only you are taking. Okay. So be very, very careful that you are not taking the total comprehensive income. Many students do this mistake. They take this one. They take the 48, the total comprehensive income, which is absolutely wrong. It is OCI, not TCI. I hope that I don't have to keep on repeating the same thing over and over again. Okay. Now let us go to the second thing, which is disposal. We are over with the accusation part. Okay. The last 3 months. So loss of control. Okay. You can write a paragraph like this. You can use a subheading like this, associate or loss of control. This helps examiner to understand and give you a lot of marks. Presentation matters a lot. Okay, the loss of control. Remember that not all sales lead to a loss of control. Yes, you have to remember that sometimes what happens when you're selling shares does not mean you're losing control, but in this case you are. Why did I say that? Because let's say assume you have 80% share, you have disposed 20%. So after you have disposed 20, you are left with 60%. So still you are a subsidiary. There's no loss of control. But in this case, from 60 you have reduced 20, so you have from 60 to, you have become to 40, which is less than 50%. So anything which reduces your share after you have disposed less than 50%, then you lose a control. Then it is associate from subsidiary. Okay, like this question. That's why the tutorial note says not all sales leads to loss of control, but here it is. But if the control is retained, what happens if the control is retained? Anyway, this I have taught in this one, when control is retained under group accusation and group disposal. But here it is explained again. When control is retained, that means from 80 to 60 or from 100 to 80, what's happening? No profit or loss. That time no profit or loss arises because as transaction is instead accounted for in equity. It's like shareholders are changing their hands. That's it. There is no profit or loss. You're not disposing it. It is not considered as a disposal, therefore no profit or loss. Because still it's a subsidiary. It's just the shareholders are changing hands, that's it. Okay? But, so now, that's the tutorial note. Okay, this all will not come in your answer. So the share sales results in Zippy's holding in Guinea falling from, you can, yes, you can straight away start saying this. Falling from this to this. Okay? Of the equity share. So Zippy has therefore lost control. Very important keyword is lost control. Okay, so he lost control of Guinea. The difference between the process from the disposal, including the fair value of the share retained and the goodwill, and NCI of goodwill is will give rise to profit. Again, very important. Maybe I can say the whole paragraph is important, so I can highlight the whole thing because the formula is given in this line only. What is it? The difference between the process from the disposal, net assets and NCI. So whatever the process you get by disposing it, now it's a disposal, right? Because you're losing control. That proceed, okay? With what? The difference with the process from the disposal and the goodwill, net assets and NCI. Okay? You are deducting the goodwill, you are deducting the net assets, you are deducting the NCI from that proceed of disposal. Goodwill you have to calculate. Net assets is given there. NCI is given there. Okay, so goodwill you have to calculate. Why goodwill? You are deducting because it's also an asset, right? Non-current asset. So that also needs to be deducted. That with it should be added with net assets and NCI of Guinea at the disposal date will give. So because of this difference between the process from disposal and goodwill and net assets and NCI at the disposal date, what happens? It will give rise to profit or loss on disposal. Important thing. These are suitable calculations. Why? Because profit and loss on disposal will go where in the profit and loss account only. So if any profit rises, any loss rises, you have to mention it. And because of this disposal of subsidiary, a loss or profit will arise. Okay. So now, and also they said the difference between the process from the disposal and also including, you have to include this. You have to add the fair value of the shares retained. You have the 40% shares, no? What is the fair value of that shares retained? That also has to be included to get profit or loss. This is calculated as follows. Okay. It is important to remember the following pro forma. It is worth a lot of marks. You see, worth a lot of marks means pro forma you have to remember. So this is the pro forma. Make two columns, okay, and write dollar millions. I just want to deal in single number or two-digit number. So I don't want to deal in 60. So you can write like this. Now starting with the proceed. What is the proceed? You are buying it. You are selling it for 44 million. With that you are adding fair value of remaining interest. Okay, exactly what I've explained in this paragraph, which I've highlighted in yellow. You can see in the calculation also. So after you write, your calculation becomes very easy because you know what you are calculating, right? Difference between process including fair value of shares retained minus goodwill, net assets and NCI. So exactly the same thing you are calculating here. Okay, so fair value of remaining interest is 62. Okay, it is given, so add both. Now goodwill at disposal working 1, net assets at disposal working 2, NCI working 3. All this 3 has working, and if you see all 3 are labeled in the order given. For example, it is not work 3 first and work 1 somewhere else and work 2. No, for it's following an order, so you also need to follow an order. For example, the goodwill was calculated first, so it's working 1, then working 2, working 3. It is following an order. Can you see? There's an order 1 2 3 4 5 like that. So we'll see the working, and the carrying amount of sub at disposal is 114. Okay, we'll go and check, and it's a loss on disposal. Okay, because this minus this. So we'll see what is the carrying amount of disposal. 114. We have to see this thing. Okay, so the net assets acquired was 114. Just wait a minute. What was it? It was carrying amount of the subsidiary at disposal. So Okay, the net assets of Guinea had a fair value of 118. This was reflected in the carrying amount of net assets. Okay. We'll go to that later. So now, before writing this paragraph, let us, before going to the remaining investment also, let us go to workings, okay? So, if you see workings are clearly labeled, you have wrote the number also. What is the number of the working? And you have wrote it also, what you are calculating. It is goodwill at disposal. Please label your workings. Don't just write working one and start calculating. What is it? Goodwill at disposal. So this is the formula for goodwill. Fair value of consideration plus fair value of consideration minus fair value of net identifiable net assets acquired. So this, everything is given in the case study. Okay, you can just put in nothing to calculate here. You have bought it at 90. NCA was 50 add minus fair value net assets acquired 114. So goodwill is 26. No impairment. So directly goodwill is 26 only. Now coming to the net assets at disposal. Okay. Let us read the tutorial notes. So the question tells you that the net assets of Guinea at the start of the year. It tells the net assets at the start of the year. So you need to add on the 9 months of total comprehensive income in order to work out the net assets at the disposal date. Total comprehensive. Please read this again. Okay. What did they say? They gave you the net assets at the start of the year. Can you take it? No. You need to add on the 9 months of total comprehensive income. That means profit plus OCI. Total comprehensive income. Okay. In order to work out the net assets at the disposal date to find the net assets. What do you have to do? 9 months you have to, because after that 9 months only you have disposing. Understood? So that 9 months you have to add with the this thing. Okay. To get the closing net asset on the disposal date net asset. Okay. So net assets at 1st of July per question. Okay. This is given in the question. 1st of July to that, this is the net asset value. Profit. Okay. So profit is 24 million and OCI is 12 million. Both together. Okay. Show both together separately. Don't just add 32 plus 16. Rather than showing 32 plus 16, sorry, 24 plus 12. We have previously calculated it, but show it like this. One is profit, one is OCI. Okay. 9 months of total profit and OCI. So 24 and 12 and add all 154. This is the net assets at disposal. Then we have NCI at disposal, which is working 3. So when working out the group profit or loss on disposal, it is normally wise to leave the NCI at disposal until last. This is because the calculation requires the subsidiary's net assets at disposal date. You see, NCI calculation should be done at the end. Okay. Most of the people struggle if they don't know the order of workings they have to do. Okay, this will cause you a lot of marks also and it will waste a lot of time if you don't know which has to be done first and which has to be done last. NCI is always done last because for NCI you need a net assets at the disposal date. To get the net asset also, it is not calculated. You have to calculate the net asset. So definitely net asset working has to be done before the NCI. You see, at disposal date when there's a disposal. So now NCI at accusation, it is 50. With this, what are you adding? Their share of post accusation net asset movement. Okay, so 40% we know NCI is 40%. Okay, and net asset we have just previously found out. Okay, the movement in net asset on that 40%. Movement in net asset is your profit only. So 154. Here just now we have calculated in working 2, which is 152. This 152 is the net asset. So this net asset only we are using here. 154. That's why they said 152 working 2 minus 114 because net assets at the date of the accusation was 114. Okay. On that, take first you deduct 154 minus 114, 114, then you take 40% of it. Okay, which is 16. So add it 66. So now let us go up 66, 154, and 26. So these are the exactly the same thing you deduct. Okay. So goodwill 26. So goodwill 26, net asset was 154, NCI you are deducting. Okay, because NCI has to be deducted from this too. Show in the first column, the inner column. 26 plus net is NCI deduct. Okay. So this 114 you are getting, it is the calculation of this 3. That's how you are getting this. Okay. It is known as the carrying amount of the subsidiary at disposal. So when you want to find the carrying amount of the subsidiary at the disposal date, this is the formula: goodwill plus net assets minus NCI. But it should be shown in the inner column. Finally, this answer you are minusing it from here, this one. Proceed plus fair value. Then it's a loss of 8. Okay. If we see a loss of 8. Now, next what do you have to do? They told the impact on the consolidated statement of profit or loss and other comprehensive income. Okay. So, when preparing the consolidated statement of profit or loss, the gain of 14 million report. How much you have the reported the gain already? Gain of 14 million reported in Guinness individual financial statements must be removed. So, in the Guinness individual statements must be removed from investment income. That 14 million gain, because it's a loss. And the group will restate. It will instead report 8 million loss on disposal. The group, okay. It will remove that 14 million this thing, 14 million gain. Okay. Instead, this must be reported, the 8 million loss. The group will report it. Next, the remaining investments. After you have disposed, definitely you will be having remaining statement. Those also has to be valued. Okay, that is your associate only. Basically, you are valuing your associate only. So after subsidiary dispose, students commonly forget to account for the remaining investment. Very easy marks can be scored here. Don't miss out on those easy marks, please. I request you. Do the question till full. Okay, you have to complete the question. After you do disposal, is not over. There are parts remaining. Okay. So now the next paragraph says the remaining 40. You see, for associate, third, fourth paragraph. Every paragraph has different this thing for every word. Okay. So now let us go to this. The remaining 40% investment in Guinea gives significant influence. You have to talk about the significant influence, okay? About the remaining 40% investment. Because from 60 to 20. As such, Guinea is an associate of Zippy. What is Guinea? An associate of Zippy. Important words. You need to write subsidiary, associate. Subsidiary is influence, significant influence. If it's a, sorry, associate is significant influence, subsidiary is control. And should be accounted for using the associate. You should account using what method? Equity method. This should be mentioned in your answer. Whenever associate is there, equity method. Okay. Whenever subsidiary is there, consolidation. This means that the groups recognizes its share of the associate's profit after tax and its shares of associates OCI. What does it mean? Can you understand the sentence? Its share mean the groups, whatever the percentage of group. Let's say group share is 60%. So on that 60% of what? The associate's profit after tax and associates OCI. Okay, that you have to take. Its share means the group's share of the associates profit after tax and their associates OCI. Now, don't forget to account for the group share of associates other OCI. Okay, because most of the what happens is people take the profit for associate, the group's share of profit for associate, but they forget to take the OCI. Please don't forget to take the OCI. Okay, if you are taking the profit, you have to take for OCI also. Now, finally, after everything, workings are over, discussions are over. Now you are putting creating the whole consolidated statement of profit or loss and OCI. Okay, so now the consolidated statement of, please label it. Okay, please label it. The consolidated statement of profit or loss and OCI will show the following number. So you need to write it that this is a consolidated statement of profit or loss and OCI. Now again $1,000,000, you are denoting it like this. Now we are writing it starting with what? So if you see, all these are workings. Okay, Okay, so you're not making the, oh, sorry, the question didn't ask you to prepare the consolidation. The question asked to explain with supporting calculations. So you don't have to make the full income statement. But wherever differences are there, you have already explained it before. How you have explained it here, you have already told. Okay, that this will be recorded here, this will be shown here. So all these things are explained. Now we are only left with the associate part. Okay, so share of profit. So what is the share of profit? 40%. Okay, remaining 40%, right? So that remaining 40% is the associate. Okay, how many months? 3 months. Okay, because subsidiary was 9 months, or associate is the balance 3 months. Okay, 3 months for both OCI and profit. Okay, this is 32 million. Same profit you are taking, that 32 million. What you have taken for subsidiary on that only, and same 16 million. Okay, from OCI. So 3.2 and 1.6. This should be shown in the consolidated statement of profit and loss and OCI. That's what they have shown, told. Okay, that this has to be shown in OCI also and statement of profit and loss, the consolidated statement of profit and loss. Okay, so with this, I have finished the first part of A. Now coming to the second part of A, okay, which is about the 10-floor office block. Just want to go through one thing. Okay, so second part is talking about 10-floor office block. This is a different standard, so we need to read about the office block. We are over with the first part, which is regarding the profit and loss and OCI. Now coming to the office blocks. Okay, so second requirement is based on office blocks for part A, second part. Now, Zippy holds properties for investment purposes. At 1st of July, had a 10-floor office block at a fair value of 90 million. So what is the fair value? 90 million with a remaining useful life of 15 years. Definitely, because it's a investment property, right? Or whatever it is, a non-current asset or an investment property. Okay, so remaining useful life will be given to you. So to calculate depreciation and all those things. So remaining useful life of 15 years. The first floor was occupied with stuff. Okay, first floor staff, occupied by staff. Second was let to Boo, the second floor. Okay, who is Boo? Boo is the subsidiary of Zippy, Okay, first floor staff, second floor subsidiary, third, sorry, free of charge, and is free of charge also, giving the one given to subsidiary. The other, so 2 floors goes. Okay, one is for staff, second is for the subsidiary. That means out of 10, 2 goes. So the remaining, the other 8 floors were all let to unconnected third parties at a normal commercial rent. When Boo vacates the property next year, now Boo is the subsidiary. Okay, he has got it free, but next year he is going to vacate the property. It will let out to third parties. So after Boo takes it, the subsidiary takes the flat or occupies the property. What is he going to do? He is going to let the, after he vacates the property, he is going to let it out. The subsidiary is going to let it out to the third party. Okay, the tenant. So it was estimated that the fair value of the office block was 96 at 30th June 2006. Okay, so fair value of office block was 96 at 30th June 2006 at this date. Now Zippy has a policy of restating all land and buildings to fair value at each reporting date. Okay, report, that means revaluation of land and buildings. So they take the revaluation of model. The old accounting entries for the year ended 30th June 2006 in relation to this office block has been to correctly include the rental income in order to P&L. It can be assumed that each floor is of equal size and value. So each floor is of equal size and value. Okay. Depreciation charged and administrative cost. Depreciation charged in administrative cost. Now, during April 2006, what happens? Hmm? An explosion at different office block caused substantial damage. April 2006. So April 2006 is before the year end, 30th June 2006. So at that date, an explosion at a different office block caused substantial damage. and it was estimated that the fair value fell from 20 to 30. Fair value fell from 20 million at this day to 14 million at 30th June 2006. Zippy has estimated that the cost of 3 million would be required to repair the block, but is unsure whether to carry out the repairs or whether to sell the block for reduced price. So he is confused whether to repair and carry it out or whether to sell the block at a reduced price. Okay, the cost is at 3 million. Okay, and this 3 million is to repair, the repair cost, but he is still unsure whether to repair also or not in the first place, or whether to sell at a reduced price. Definitely it is damaged, so he cannot sell at a high price. Reduced price only has to sell. So the property has been left in the financial statements at a value of 20 million. Okay, it is not kept like this. The property is in the financial statements at a value of 20 million. It is left like that. A provision of 3 million of the repair cost was charged to other costs. So provision of 3 million for the repair cost is charged to other expenses. Okay, that's it. Now let us do the first, both second and third requirement we can answer. Second is relating to the consolidated financial statements with suitable calculations we have to explain, and third is about the accounting treatment, 4 marks. Okay, so coming to the 10th floor office block. Okay, in this part of the question there are more marks available for discussion than for calculations. Even if it's 8 marks, it's not equally 4 marks. More is for discussion than calculation. So which standard you are using? This is an investment property. It is IS 40. Okay, IS 40 is the standard. What does IS 40 say? IS 40 says that the proportion of a property can be classified as investment property. Portion of a property, yes, definitely. Even if the whole property you are not using for investment purpose, even if we are only using a portion of it, IS 40 says you still can classify that portion as investment property if they can be sold or leased out separately from the rest of the building. Not only that, portion of property can be classified as investment property only if it can be sold or leased. Okay, only if it could be sold or leased separately from the rest of the building. For example, out of the 10 floors, if the 1 or 2 floor you can sell separately. Okay, so not only sold, even leased separately, it is considered as an investment property under IS 40. Okay, if you see the answer by now, I think this is the 7th question. So from first to 7th question, if you see the pattern, all the question, the first paragraph, they always start with the standard. Okay, the rules of the standard, they start describing it first. IS 40 says this, this standard says this standard says that. Always they introduce it, they answer with the standard. So this is a skill in SBR that you have to start your answer with an standard. For that you should know also which standard is applicable in that. Sometimes in a question you see 2-3 standards are required for one question. Sometimes it's just standalone only one question like this. It is only IS 40, which is more easier, right? But you need to know, because no question, nowhere it will say that this is the standard you have to use, this IFRS, this IS. No, you have to decide. Because some of you, what happens is, rather than using investment property, you might use IS 16, which is for non-current asset. Another totally different standard only you might use. So there are confusions like that. In order for you to not to create confusions by reading the scenario, always first exercise you have to do in SBR, try to pick up the standard. What are the standards applicable in this question? Once you're able to pick that up, right, trust me, you will do wonders. The only hard part is to get the correct IFRS or IAS for that requirement or a question. That is the only hardest thing. Rest all you have already studied all the IFRS and IAS, so once you are able to pick it up correctly, you will be able to apply it also. Application you will know. Picking up is the challenge. Okay. Now, so now this is like in 2 lines or 3 lines, you are just giving the principle of IS 40, whether it could be classified as investment property or not. Now let us go to the second paragraph. You are actually saying, referring it to the case study and saying in Zippy's what's happening. So the property occupied by subsidiary does not qualify as investment property in the consolidated financial statements. Does not qualify as investment property. The property occupied by a subsidiary. By whom? Please mention clearly. Because there were two. One is given to employees, the other one is given to subsidiary free of cost. So it is, so they are saying the one given to subsidiary, okay, property occupied by a subsidiary does not qualify as investment property. That is not as investment property. The one you have given to subsidiary. In the, where do you write investment property? Non-current asset, no? Under non-current asset. And where does it go? In the statement of financial position. So definitely in the consolidated financial statements, right? It will go there because it is being used by the group. Why it will go in the consolidated financial statements? Another very good question. Because it will be used by the group. Anything used by the group goes in the consolidation account. Remember that. It is used by the group. How by the group? How it is used by the group? Subsidiary, no, it is given to the subsidiary. So subsidiary is a group, no? The parent is given to the subsidiary. So that parent and subsidiary are in one group. That's why we make group financial statements. So even for investment property also, okay, that investment property, if it was an investment property, it would have gone in consolidated financial statement. So now they are saying this will not be qualified as investment property in the consolidated financial statements. In which place? Consolidated. Because one might be thinking that why consolidated, because this is just a subsidiary, so why not individual financial statement? The reason is because the parent is giving it to the subsidiary. So parent and subsidiary are one group. Okay, they are always considered one group. So hence consolidated financial statements. Okay? Investment property, if it was recognized, you could have gone there, but now they are saying it is not recognized in consolidated financial statements. Next, the first two floors of Zippy's office block should therefore be classified as what? Clearly you are mentioning. Okay, so the first two floors of Zippy, you are linking it to the case study of Zippy, should be classified as PPE in the consolidated financial statements. Very important. Property, plant and equipment. If it is not classified as investment property, then it is classified as what? PPE, property, plant and equipment. Where? Same. Consolidated financial statements. As I told you, property is used by the group. Okay? Because the 8 flows are used by the parent, the one is used by the subsidiary who is in the group. So consolidated. Okay? Next. So now the question comes. Now it is PPE. All the features of non-current asset will be applicable here. Whatever the extra things you have to calculate relating to non-current asset of property, plant and equipment is now applicable. So this shall guide you towards your answer. To what are the things more to write? Depreciation. Non-current asset, depreciation will come. So calculate depreciation. Right? So the next paragraph is about depreciation. Okay. How much? It is 1.2 million. And where is it? It should be charged to admin cost. Depreciation is where? Under what cost? It is given in the case today, I think. The depreciation is under what? Depreciation is charged to admin cost. Admin cost only. Okay. So it should be charged to admin cost. And how much? We have been told the useful life is 15 years. Okay. But 19 to 0.2. How 19 to 0.2? If you see, on 1st of July 2005, the opening paragraph, first paragraph under office block, held 10 floor office at a fair value of 90 million with a remaining useful life of 15 years. So 90 with a remaining useful life of 15 years. Okay. But why is it 0? 0.2. You have multiplied it by 0.2. Any reason for using 0. The reason is it is a proportion. How many floors are there? 10 floors. How many flows is taken as taken as a PPE? Only 2 flows out of 10, because we have told the first 2 flows are not, it is not considered as an investment property. It is classified as PPE. So only those number of flows which is PPE, only you have to find depreciation. For investment property, you don't have to find depreciation. So the 0.2 they have got because it is simply nothing but 2 divided by 10. Okay, the 0.2 here, it is 2 divided by 10, because out of 10 flow, 2 flows are PPE. Okay, that's why 2 divided by 10, 0.2. So admin is 1 point, depreciation is 1.2, and it goes in admin cost. Next, because, and also revaluation, now PPE. So all the features of PPE. Next is what after depreciation is revaluation. We have been told, right? Revaluation model. So remaining, sorry, the first 2 flows should be revalued. First we talked about the first 2 flows, then we'll talk about the remaining 8 flows. Okay, both will talk separately, but first 2 flows should be revalued to what amount? 19.2 million. How 19.2 million? 96 into 0.2. And where will it go? In the statement of financial position. That means in the balance sheet. Because once you revalued the PPE, where will it go? The revalued amount will go in the statement of financial position, no? But before we find the gain or the loss devaluation, how 96 into 0.2? Because 0.2, see 0.2, wherever you see 0.2, it is simply nothing but 2 divided by 10. Out of 10, 2 floors are PPE. So only those 2 floors will be revalued. We have clearly written in sentence also the first 2 floors. Out of 96 million, okay? So we'll say 96 million. So if you see here, second paragraph, it was estimated the fair value of office block was 96 million. So because the fair value of office this thing was 96 million, out of that only 2 out of 10, which will be revalued. Okay. Just give me your time. So now we know how 19.2 out of that fair value of 96, 0.2. Okay. Now a revaluation gain should be recorded with OCI. Where does the revaluation gain goes? Please answer me this question. Revaluation gain goes in OCI. Okay. So after seeing this question, don't ask me where does revaluation gain goes, because what annoys me the most is some of the students, okay, not some, very few, okay, it's not annoying, but then it's kind of like you actually don't see my video in full, or you don't take it seriously. That's what I mean. Because when I have spoke about something in my video before, I don't know whether students, they see my full video or they don't see the video, and they start asking me questions which I have already explained in the video. So my request is, please check the video in full before you ask me any questions, right? Then if you ask me any questions, it does make sense. And but what annoys me to most is the same similar questions is asked which I have already answered, right? So it's better that you see the video in full rather than me explaining the same thing over and over again, over and over again, because it's hard. It's hard to type and explain you, right? That's why I'm creating these videos. Otherwise, I could type and write the answer and give you, or I could just say read the answer by yourself. But the way someone understands through explaining and me just writing answer by replying you by writing is different. You will not understand everything when I write. That's why everything is in the video in detail. I explain, I break down, I take, right? I don't rush through. I take my own time and then I explain so that everything is clear, right? Still people ask me, how did you get that figure? How did you get this figure? Why it is multiplied by this one? Why we have taken this by? Already I've explained. I always explain the reasons behind the figures I get from. How did I calculate? So I don't think it makes sense that you keep asking me the same questions over and over again. right? That's why you see that I don't even reply most of it. If I see that I have already explained it in the video, I will not reply. Simple. Because it shows that maybe you didn't watch my video and then you are telling me to explain. Then what's the purpose of me making the video if you have not gone through my video in full? Right? See the hard work you have to do of going through the video, even though it's 2 hour, 1 hour. You have to take the time out and see it. It's you who has to pass and give this exam, not me. Right? I'm trying to make the video as short and easy for the viewers to understand and relate as much as I can from my side. So you also have to take from your side also the initiative to actually see it, go through it, and then if there is any question, then it's okay, we can solve it. But every time asking where did you get this figure, why it is calculated in this place, why, I don't think I have to answer it after I explain everything in video in this much of detail. That also I keep on repeating, not just once, but many times. Because I know students do this mistake, they keep on forgetting, so I know the tendency. Okay, so please don't do it. And where was I? Okay, yeah, I'm sorry. Yes, revaluation gain. So revaluation gain goes in OCI. And how much is the revaluation gain? 2.4 million. How? How? See, depreciation, you need to deduct the depreciation. Okay. In the revaluation gain, when you are taking, remember, what are you taking in the OCI? Okay. Here, if you see, it is 19 to 0.2 minus 1.2. Okay. And 19.2, which is this. From here, you are deducting this and you are getting this 2.4. Basically, the gain you are taking. Okay. So when you are revaluing something, okay, you definitely have to take minus the depreciation. Okay, so that's why this 1.2 is that depreciation only. Okay, here you can see the depreciation 1.2. So this 1.2 is that depreciation, you have to deduct it. Even for the cost also you deduct, even when you revalue it also you deduct. Okay, and they told that it should be revalued to 19.2. So this 19.2 is here. Okay, and from here you need to deduct what? 90 into 0.2. What is this 90 into 0.2? This is the cost. This is the cost of the two floors, the fair value before the revaluation. So it's like revalued amount minus the cost minus the depreciation. Okay, three things. Number one, number two, number three. Three things I am deducting separately. Okay, 90.0.2. If I'm not, you forgot the figure. Okay, no worries. So here you can see they have a fair value of 90. Okay, and 90 million for two floor. So it will be into 2 over 10. Okay, so from here you will be revalued. Okay, this is like the cost, that's why you're deducting that 90 into 0.2. So 19.2 is the revalued amount minus that the cost and minus the depreciation, which is 1.2 million, which you have previously calculated also. Then 2.4 million, and this is the gain. Okay, it's a gain because from 19 to 0.2, what is 19 to 0.2? 18. So from 18 your value went to 19.2. Okay, the for the first two floor, that's why 19.2 minus 18 minus the depreciation 1.2. Okay, that is the formula for finding the revaluation gain, and that gain will go to OCI. Now come to the next paragraph. Next paragraph will talk about the remaining two paragraphs, last and one before the last, both talked about the remaining 8 floor. Okay, so the remaining 8 floor, remaining 8 floor, they qualify as investment property, right? They are investment property. Only the first two are, the two of it are PPE, property, plant and equipment. That's why we had to revalue, we had to find depreciation, all those things, and we have to, it will follow the features of non-current asset. Okay, now this is an investment property, the remaining eight. So investment property measured at fair value is not depreciated. You see, investment property measured at fair value is not depreciated. That's a rule under investment property, IS 40. So go through IS 40 and see that fair value, when because they told they are using the revaluation model, that means fair value model. You have an option, either fair value, either cost model. So in the investment property, there's a rule that says that when you measure it at fair value, you cannot depreciate it. It is not depreciated. These things you have to remember, okay? This details you have to remember from standard. If you don't remember it, my dear friends, then it's not, you'll be struggling a lot in SBR. SBR is all about rules and regulations only. And if you are not good in SBR, you cannot be good in audit also, because you need the help of SBR very hugely in your audit, P7. Okay. So what happens? But the gain will be there. Right? So the fair value gains related to investment properties are recorded in P&L. Just now I told revaluation gain or fair value gain, whatever it is, goes to OCI. Now I am saying P&L. Why it is profit or loss? Because under some standards, not everything goes in OCI. This is why you have to go through each standard. When you're studying, also study the standards as standalone standard. Study separately, later try to integrate all the standards. Okay. First, studying phase, you are studying individually. IS 40 as a separate standard, IS 60. Don't mix the two. But when a question comes, everything comes together. That's the problem. I know, I can understand. That's the issue with the students. How to solve questions like this, because all the standards coming in, how do I know which standard? So it is simple, just see the wordings. Investment property, that word will be there, investment property. That means IS 40. Or property, plant and equipment, or non-current asset, that means IS 16. Or financial instrument, that means IFRS 9. So such words are there which will tell you which standard. Okay. So next, so in IS 40, fair value, when you take into fair value, it is not in OCI. Okay, go through my video in IS 40, which I have not yet uploaded. It will be uploaded soon. So the rules will be there. Okay, fair value gain in IS 40 goes to PNL. Okay, related to investment property, the 8 flow. It is related to investment property. Okay, please don't get confused with the other two. It will go to profit or loss. Okay, next, revaluation of 8 flow. So this 8 flow should be revalued to what amount? 76.8 million. How 76.8 million? 0.8. See, before it was 0.2 first two, now 8 divided by 10. 96 only, because this is the revalued amount. 96. In where? Statement of financial position only it will go, right? Next, in the, and revaluation gain is how much? Two things you have to calculate. One is the revalued amount, second is the revaluation gain. Third thing, where will that gain go? Okay. How did you calculate the gain? And it will be recorded where? Gain, statement of profit or loss only. Okay. But it will be recorded as an investment income. Please understand. In the, you can say okay, it will be recorded in statement of profit or loss, but it will be recorded as what? That also you have to mention, whether income or expense. This is an investment income. Okay. But if it was PPE, nothing goes to profit or loss as an income. Depreciation goes relating to it. The gain goes in the OCI, and in the statement of financial position, the revalued PPE goes. But when it comes to investment, investment will go to statement of financial position as an investment property, but investment income will go in the profit and loss account, and profit will go to profit or loss, the revaluation gain. Okay. So what is the revaluation gain? 76.8. This is the revalued amount minus 90 into 0.2, because 90 was the fair value before the revaluation, into 0.8 because only for 8 floors. Okay. And you are not deducting depreciation how you have deducted for property, plant and equipment for the first 2 floors. The reason is because they told that if fair value is there, it is not depreciated. You see here, you are just applying the standard only. Investment properties measured at fair value is not depreciated, hence you did deduct minus depreciation also in the calculation. Okay, coming to explosion. Okay, so each thing you're tackling, can you understand? Everything I'm tackling one by one. I'm breaking down the big thing into many parts. First I discussed the first two floors, then I discussed the eighth floor. Now I'm going to the explosion part. Explosion as a separate thing. Okay, separate subheading I'm using it, because from here onwards different standard comes. Okay, I've told you this is a very good question because so many standards. You see IS 16, IS 40, IS 36. Then what are the other standards? Yeah, so it's a good question. Three standards already we have used here in this question. Even IS 37, I can see four standards are there. One is IS 36, one is IS 37. So it's a very good question that four standards are there in one question. And also in the next part we have IFRS 10 also relating to individual financial statements. IFRS 10 is about individual financial statements. So now I can go IS 36. Why? Because they told about destruction due to explosion. So whenever destruction of an asset comes, it is dealt under impairment. It is meant as that value of asset went down, therefore impairment. Impairment is dealt under IS 36. So IS 36 impairment of asset does not apply to investment property. Please understand this. Investment property, no impairment. Does not apply. You cannot apply IS 36 to investment property, IS 40. That is measured at no. Hold down. That is measured at fair value. Understand? This is why you need to read the whole thing, okay? Most of you will be reading only that part and get confused. No, it does not apply to investment. That is measured at fair value. And in this case, it is measured at fair value. So no impairment. So investment properties under the fair value model are simply restated to fair value with the gain and loss recorded in P&L, okay? They are restated to fair value. You might be having gain and loss, okay, from previous value to this value. If okay, so that gain and loss will go in the profit or loss, okay? Next, the building should be revalued to 14 and a 6 million loss. They have talked about something, right? That some loss and some gain is there. Okay. So what are they saying? So if you see here how they have breakdown, first paragraph, they have, no, sorry, I'm sorry. First paragraph talking about IS 36 and how fair value gain and loss will go. Second paragraph only two lines. Okay, how the building should be done. Okay, so building should be revalued to 14 million. This talking about the building. Okay, feel like breaking this pen now. Oh God. So building should be revalued to 14 million and 6 million loss. How 6 million loss? 20 minus 14 should be charged to investment income. Oh, there was a 6 million loss something. Oh, that's our gain. But we have calculated 6 million loss somewhere. No, this is the subsidiary, not this one. I got confused because they have to 6 million loss from 20 to 14. So we'll go and check. So if you see here, okay, they told fair value fell from 20 million to 14 million. You see, it fell from 20 to 14 million. That's why 6 million loss. And also the property have been left in the financial statements at a value of 20 million. The last sentence says that. Okay. So 20 minus 6, 14, 6 million loss. Okay, and it needs to be revalued to 14 million because it fell from 20 to 14 billion. So it needs to be revalued at 14 million and with a loss of 6 million. Okay, and it should be charged to investment income. Okay, the 6 million loss. Definitely you must be having some this thing, right? No, I mean that loss goes in the P&L as investment income. Okay. No, this is separate. This is related to building. That one was relating to the office floor. Now next let us go to the IS 37 because they have told something about provision. So anything if provision is mentioned, IS 37, and it's a very famous topic. Okay, trust me, IS 37 is loved by examiners. Sometimes they give two three times also in the same paper. In three different questions, IS 37 is mentioned, right? So IS 37 is a very favorite topic of examiners. So very high chance of getting IS 37. Same for impairment of assets. IS 37 says that a provision should be recognized if there's an obligation from a past event that will lead to probable outflow of economic benefits that can be measured reliably. This is just a definition of they are giving of the provision from the textbook. Okay, that there's an obligation if past event says that there will be probable outflow. Okay, that could be measured reliably. Now, the provision of 3 million should be reversed through expenses as there's no obligation to carry out the repairs. You see, it should be reversed means it should be taken out from there. There's a provision, right? Credited, it should be debited now. The provision has to be out from there. Why? No provision should be recorded. That's what the reversed means. How it will be reversed? Through other expenses, right? Provision is there in the other expenses. You take it out from there. We'll see where's the provision recorded. Did they give the place? Yes, provision is charged to other expenses. The last sentence I have underlined also, other expenses. Therefore, they told it needs to be reversed. So, see, always whenever they say it is recorded under some places, always mention that place. For example, even for depreciation also, we told that it will be there in the admin expenses because the case study told it is there in the admin expenses. If there is no such line that they does not say it falls under which category, then you don't have to mention the category. But if they mention the category specifically, for example, this is included in this cost, this is not included in this cost, you need to mention that category. Okay, like that, likewise for provision we have mentioned that through other expenses. Okay, other expenses because in the case study it has been mentioned that provision is recorded in other expenses, so now you have to take it out from other expenses. Okay, reversed it. Why provision will not be recorded? Clearly they have told no obligation because the definition itself says there should be an obligation from the past event, but there is no obligation to carry out the repair of the building. It's your choice whether you want to do it or not, but it's not, you don't have an obligation to repair it. Therefore, it's not, provision should not be recorded. Next, we are going to the third one, individual financial statements. Okay, why it is different to the consolidated financial statements for 4 marks? That was the question, and no, they told no calculation is required. This is fully theory. Okay, and the topic you can write, always write your topic. Okay, subheading for every answer. This is individual financial statements. They always keep the subheading short and to the point. Okay, so now according to IFRS 10. Okay, why IFRS 10? Because IFRS 10 deals with consolidated financial statements. Okay, so consolidated financial statements present the parent and its subsidiary as a single economic entity. We know that they are considered as one entity, parent and subsidiary. Second floor. So now what are we doing here? The question asked about the office block. So we are talking about the office block because in the individual it is recorded as something else, in the consolidated is something else. Why is the difference? Accounting treatment you have to explain. Second floor of the 10 floor office building is being used by another group member. Used by another group member. So the keyword is it is used by another. Wait. Just I'm so very annoyed right now because my pen is not working, guys. I hope that you people used. Okay, thank God, finally. If I don't use it for a long time, it doesn't work, right? So it is being used by another group member. Okay, what does it mean? This means that it's being used within the same single economic entity for administrative purpose. That means same entity, right? It's like you, your brother, your sister, all the siblings, they are considered as one family, right? Same like that. This is one group. The second floor must therefore be classified as PP in the consolidation. This is like repetition of what we have told before. So the second floor, it is PPE classified as this one in the consolidated financial statements, okay? Not in the individual financial statements. You have to write the place. Second, in the individual financial statements of Zippy, Zippy is the subsidiary, sorry, no, the parent. The second floor qualifies as an investment property. You see, in the individual, okay, in the individual, it is investment property because it is a part of a building. Why it is investment property? Because it is a part of a building held to earn rental income. You can earn rents through that by giving it to your employees or your subsidiaries. You can earn revenue. Even though to subsidiary you are giving free of charge, but at least through employees you are getting a rent. So they told that through this you are getting a revenue, rental revenue or income. That's why they classified in the individual financial statements as investment property. Even though there is no rent is charged at the second floor, yes, definitely, because the second floor is for the subsidiary too. For there they told it is free of charge. No rent is charged currently. Okay. Next, as a result of this classification difference, what is the issue with the this thing? It is the classification difference only. Okay, classification difference. Consolidated financial statements, it is recognized as property, plant and equipment. That means IS 16. Individual financial statements, it is recognized as investment property. That is IS 40. Okay, and also the principles are different. That means principles relating to it will be different. For example, one thing is depreciation. One difference is in depreciation. So depreciation charge in the individual financial statements will be lower in the consolidated financial statements, right? Definitely will be lower. Depreciation will be lower where? In the individual than in the consolidated. That means in the consolidated depreciation will be more. How? Because in the consolidated it is recognized as PPE, no? So PPE you are calculating depreciation. But in the individual financial statements, because you are writing it as an investment property we told because we carried out at fair value, there no depreciation is charged. So no depreciation in the individual financial statements because it is investment property, but in the consolidated because it is PPE, depreciation is there, therefore it will be higher. Next, the carrying amount of the investment will be higher than in the consolidated. So the carrying amount, from that point only you are leading onwards. This is not a new point. Everything is same point only. It is higher in the consolidated. So carrying amount of investment property, investment uh, carrying amount of investment property will be higher than in the consolidated financial statements. You see, because investment has no depreciation, right? And also in the individual it is recognized as investment and no depreciation. So what is it saying? That the carrying amount of investment property will be higher than in the consolidated financial. That means in the individual financial statements it is higher, the carrying amount of investment property, because no depreciation in the individual financial statements. Okay, same point only. Okay, we are talking about that only. That classification, we are talking about depreciation, we are talking about the carrying amount. Now we are talking about the revaluation gain. Okay, three things. This is how you are getting the 4 marks. First, to identify the difference, then we are building up on that point. So the revaluation gain in OCI will be lower because what are we doing? Difference between individual and consolidated. So we are saying here it is lower, here it is higher. These are the differences. Simple, no? OCI will be lower and gain in PNL will be higher than in the consolidated financial statement. That means in the individual financial statements, they are talking about that the revaluation gain in OCI will be lower. There are two types of gain, okay? One is going in OCI, one is going in profit and loss account. The one which is going in OCI will be lower in the separate, individual statements. Why? Understand the reason also. They didn't give you the reason here, but you need to understand the reason behind it. Because if you don't understand it, how can you write lower or higher? You can only write it if you have understood the concept behind it properly. So you have to imagine. This is the art of imagination. In SSC, is everything you write is all about imagination. In the back of your mind, you have to make this scene. Imagine this is happening. This place I'm recording. Even though you're not recording it physically, individually, yeah, you are like imagining that you have recorded. Then you're thinking, okay, if I've recorded this, what is the impact on this place? What is the impact here? What is the impact there? This is what I call imagination. If your imagination is good, your answer will be good. Okay. Now, forget about everything. It's like you have to focus your mind in one direction. You have to always clear your mind and come back. Now, forget about everything. Now, think about revaluation gain only. It is recorded in OCI. Okay. And why it will be lower in individual financial statements? Because in the individual financial statements, you are recognizing it as an investment income. And for investment income, nothing is going in OCI. The gain is going in profit and loss account. That's why it is lower. The gain of revaluation goes in OCI only when it is recognized in as profit and PPE, which is in consolidated. That's why in individual financial statements, OCI will be lower. Correct? Coming to the gain. Why gain will be higher? OCI is lower, but gain is higher in individual financial because no depreciation in profit and loss account in the individual financial statements because investment property, no. So gain will be higher. But when it comes to the consolidated financial statements, because of depreciation, because you have recognized 8 flows as investment, 2 flows as the property plant and equipment, we are only talking about the 2 flows, okay? Not talking about those 8 flows. Because those 8 flows, both places it is same. Consolidated also investment, individual also investment. We are only talking about those 2 floors because the difference is only for those 2 floors. Separately, it is in investment. Consolidated, it's PPE. Okay. So PPE depreciation goes because of depreciation, your profit reduces. Depreciation goes in the profit and loss account. Only the revaluation goes in the PP, but depreciation will go in the profit and loss account. It will reduce your profit in the combined statement, consolidated statements. But in individual statements, investment income, so it will be higher, the profit. Now coming to part B. With that, we are over with part A. I know it has taken such a long time, 1 hour 30 minutes, when just to explain part A, all the 3 requirements. Now, no worries. I think quickly we can finish part B. Part B is what? OCI. Discuss the difference between OCI and profit and loss and the rationale as to why some gain and losses can and others cannot be reclassified to P&L loss. Include in your answer a brief discussion of the benefits of. Okay, 2 things. One is differences. Why some gain and loss can be or cannot be reclassified to P&L. Okay, for this you need the help of IS1. Okay, please go. You can even go to my video and check IS1 and for this part. Okay, forward my video and go to only this part where I talked about reclassification. We discussed what are the items that will be reclassified, what are the items that will not be reclassified. Okay. There's a list. And why it is classified or not reclassified also explained. Okay, it is not explained, but we'll see here. It is not given in detail there. Okay, but in the answer we'll see. Okay, so include in your answer a brief discussion of the benefits of immediate recognition of remeasurement component under IS19. IS19 is related to employee benefits. Immediate recognition of the remeasurement component. Why they have talked about only this part relating to this? The reason is because this is something which will be reclassified or it will not be reclassified. Can you remember? I will not tell you the answer now. When we solve the answer, I will tell you there. Okay. Now let us read this paragraph. OCI. So the directors of Zippy are unsure as to the differences between OCI and profit or loss and other ratios to why some gains can and they are not understanding why some are reclassified, some are not reclassified to P&L. The difference between OCI and profit and loss account. They are not explaining their reasons. Zippy has a defined benefit pensions and directors have further local gap in some countries allows actual gains and losses remeasurement component to be deferred using an applicable system rather than being recognized immediately. So to be deferred, okay, the remeasurement component using gap it can be deferred using an applicable systematic method rather than being recognized immediately. They are not right. Brief discussion of the benefit. Okay, so you have to discuss the benefit of immediate recognition of this remeasurement component. But in some gap, they don't recognize the remeasurement component immediately. They defer it. That's what they are saying. So now, what are the benefits of immediate recognition? That you need to include in your answer. Okay. I hope this answers and no calculation. So I think quickly we can finish this in within 10 minutes maybe. We'll see. It depends on the answer. Oh my God. The answer is quite big enough. Okay, we'll try to finish in 10-15 minutes. Yeah, okay. OCI. So this is the topic. Okay, it is a popular exam topic. Popular exam topic says it all. The moment popular is there, we know what to do. Study and come. Make sure that you are aware of current events about its nature and use. Make sure. Next. I'm not going to explain each and every line breakdown and all because everything, most of this, okay, 90 to 95% of this topic I have explained in IS1. So please go and check my video on IS1. I've explained there. I'm not going to waste my time repeating the same thing here again, but I'm just going to read the answer and just go through it so that you know the nature of this answer. And it's for 7 marks. So we could just say maybe the 3 marks or 4 marks for the first part. For the why it is or why it is not reclassified to PNL, the OCI, and the remaining 3 marks maybe for the benefit of recognizing the remeasurement component relating to IS19 immediately. Okay. Profit or loss includes all items of income and expense, except those which are recognized in OCI as required or permitted by IFRS standards. Something easy to understand, nothing to explain. Conceptual framework states that profit or loss is the primary source of information about the financial performance of an entity, and so income and expenses are normally recognized in that statement. According to conceptual framework, an income or expense is presented in OCI if it results from remeasuring an item to current value and if it means that profit or loss provides more relevant information or more faithful representation provided of an entity's performance. What does it mean? It says that when you remeasure it to the current value, remeasurement, that comes in OCI if profit or loss provides more relevant information or faithful representation. Okay, so all this is then in conceptual framework. You can go to conceptual framework also and see, right? It's like a copy paste. Okay, same thing. I'm not going to explain. Same thing. Okay, go and check. The board makes decision about OCI on a standard by standard basis. This you need to understand. They don't make decision overall. General decision they cannot make, whether they have to classify an OCI or not. Standard by standard, each standard they will see. For example, just now we have done a standard. In investment property, when you use a fair value revaluation model, you cannot put it in under OCI. The gain will go in the profit and loss account. But the same thing when when it was classified as property, plant and equipment, that revaluation gain went to OCI. So standard by standard basis. Okay. Every standard deals differently related to OCI. Not everything is recognized on OCI. As they are revised or issued. Now we're talking about income and expenditure included in OCI should be reclassified to profit and loss. Now they are saying when they should be reclassified. Okay, it should be reclassified to PNL. The one income and expense which are recorded in OCI should be reclassified to PNL when doing so results in profit or loss providing more relevant information. Number one is this. More relevant information. Okay, when you do it and profit or loss provides more relevant information. Number one reason is that. Number two. There's no number two. Okay. Again, these decisions are made on standard by standard basis only. Sometimes according to standard, it becomes more appropriate for you to, or it becomes more relevant if you reclassify. Okay. Again, this decide, okay, the board may decide the reclassification is not appropriate if there is no clear basis for any the amount of time at the reclass. This is they are saying reclassification is not appropriate. Okay, they are supporting not reclassifying. If there is no clear basis for identifying the amount or the timing of the reclassification. When are you going to reclassify or the amount? When you cannot, there is no clear basis for it identifying, then we don't reclassify. Why do you take a risk, right? Something which is very uncertain, we don't take risk. With regards to defined benefit pension scheme, now they are bringing their answer to this one. The answer is longer than expected. Okay, so please, you don't have to write everything. The reason is because maybe it's for 3 marks or 4 marks, and this is not an answer for 3 or 4 marks, and you will not get the time also to write this much. This is just for your pure understanding, because some of the candidates, they study from the revision kit rather than from the textbook. So it is for those students. It's like copy pasting the text from the textbook to revision kit. It's like that only. The service cost is immediate recognized in PNL. Okay, so if it is a defined benefit pension scheme, this one, the service cost is immediately recognized in PNL. The remeasurement component is recognized as other. So remeasurement comes where? It comes in OCI. And it is presented as what? Please note this. It is never reclassified or not reclassified. It is classified like this only, and you have to know the classification. It is presented as an item not to be reclassified in the profit or loss in the future. It is always in the OCI only, relating to pension benefit scheme, if there's any remeasurement component. The remeasurement component compromises errors within actual consumptions, right? Error could be there, right? Within actual assumptions. These are assumptions which we are using, so errors could be there about life expectancy. See, assumptions on what? When we are calculating those, aren't we assuming the life expectancy that 60 years, 50 years? Because we have to give pension, no? Then wage inflation, we are assuming how much the wage will inflate. Service lives, how much they are going to stay there in the service, as well as difference between actual and expected returns. Even the actual and expected returns might be different. It can be argued that there is no correlation between such items and the underlying performance of an entity, thus justifying the decision that this should never be reclassified to P&L. You see, you're justifying the decision that it should never be reclassified. How are you saying that? Based on all those things. Because there is no correlation, number one. You are saying why it is better not to reclassify because there is no correlation. And also the underlying performance of an entity between such items and underlying performance, between these two, there is no correlation. That's why don't reclassify. Next. That said, reclassification is criticized for adding unnecessary complexity to financial reporting. Okay, so all this they are criticizing. It is criticized. How? Unnecessary complexity, isn't it? To financial reporting and potential earnings. Because of this, it will help earning. See, these are like the disadvantages. We went through this in the when we were going through this. Earnings management. Because of this earnings management, you can manipulate your earnings. Why? You can record something which should not be reclassified. Okay, from OCI. See, sometimes some items might need to be reclassified to profit or loss account, but you don't do it. You put it in OCI because you know most of the people look at, or sometimes you will reclassify even if it's not supposed to be reclassified to profit and loss account to show your profit bigger. Because what happens, users don't see OCI so much, they see profit and loss. So that is ignored. So through OCI you can hide some things. Okay, earnings management. So you can manipulate your earnings like that, like this. Reclassification could be easily misunderstood as essentially the same. Okay, it could be easily misunderstood also, the reclassification, isn't it? Because same gain gets sometimes the same gain gets reported twice, once in OCI, once in PNL. Okay, So additional, it is likely that there will be a mismatch. There could be a mismatch, and also reclassification on reclassification, as the gain on the loss may be reported in a different period to when the underlying change in variables took place. Yes, sometimes what happens is relating to the income or expenses relating to an asset or a liability will be in a different period. Asset or liability must have arose in a different accounting period. But when you reclassified from OCI to profit and loss account, that period is different. It's not matching. So even according to conceptual framework, it's not matching. It's not going in line with the conceptual framework's principle. It says that income and expenses should be recorded in the same period as when the asset and the liability relating to it took place. But here it is not so. Okay, reported in different period. All these are issues of reclassification. Okay, next, pension and immediate. You see, you are giving headings like this: pension and immediate recognition benefit you are giving. Okay, so we know that gain and losses, they vary significantly from one year to the next. Okay, what type of gain? Actual gains from one year to next. So immediate recognition may create volatility within the similar financial position or the comprehensive income. It creates volatility. Okay, immediate recognition. You are giving the benefit, no? Statement of financial position and other comprehensive income. Because why didn't you say profit and loss? Why did you say other comprehensive income? Financial statement and the reason is because actual gain or losses goes where? Just not go in the profit and loss account. Just now we went through it. It goes through OCI, which is not reclassified to P&L. That's why. Okay. It is, however, important that users are fully aware as to the extent of an entity's pension scheme obligations. This may not be evident if there's a deferral of the. This may not be evident if there's a deferral of the remeasurement component. If there's a deferral of the remeasurement component, they will not be aware of the pension scheme obligations. Okay. So disadvantage of deferral means advantage of immediate recognition. Same thing only. It can be argued, therefore, that the immediate recognition leads to greater transparency. So immediate recognition leads to greater transparency of the financial statements. Everything becomes transparent. You know the obligation of your pension scheme obligations. You become aware, and it is recorded in the same period. Immediate recognition. So transparency is increased. Nothing to hide. Nothing to conceal. Right. Whereas deferral, it could be manipulated. Right. It's not transparent. Such. So you have give the benefit of immediate recognition. So marking scheme is not given, but you got an idea how to answer a question like this. And if a theory question comes, how to answer in SBR, a lot of students every day they mail me asking me to make a video on how to answer theory part in financial reporting in SBR in some other papers also. So see, I cannot make a video like that because if I come to make a video on every theory question, see, definitely when I'm doing calculation under every question, I am solving that thing only. I am discussing how to write theory parts, right? I'm telling you how to write start, how should be your ending, what are the main words in the paragraph, how to write it in different paragraphs, how to use the subheadings. So I'm telling both, right? Through solving a question, I'm explaining that part also. So I don't think I have to create a separate video on just how to answer the theory parts. It is already answered in the revision kit questions, right? So you can follow the issue comes when you don't see my video full, right? So if you don't see, it's not my fault. I cannot help it, guys. You should help yourself. So that's it, and with this, let me end this and see you in the next question. Till then, take care. Bye bye.